Good afternoon and Sawadee Krap. Thank you so much firstly to Kun Pawan and the organizers for having me here to speak. It's the rainy season right now, but there's really never a bad time to be in Bangkok because khao soi is one of my favorite things in the world. I was quite surprised at the timing when they were asked, but I wasn't expecting that when we would actually be here, gold would be hitting new record highs. So it's a good timing to be here on many, many fronts. As introduced, I'm the Asia strat for JP Morgan in the region, and I cover currencies primarily. So for those of you who don't understand what that means, I'm the guy that they blame when the dollar baht forecast gets wrong. But today I'll kind of walk you guys through the kind of macro picture for gold and how, you know, it's really in an era of excess scarcity becomes very, very valuable. And that's really why we see gold moving to $4,000 and beyond, 60,000 Thai baht per local baht and beyond. Yeah, now let me just give you guys an overview of how that's going to happen. So yeah, like I said, welcome to the era of excess. And what is excess? After all, inflation is really just an excess of demand over supply. And this is why when we think about inflation, a lot of the excesses are really coming from the kind of dynamics that we're seeing, particularly on the US fiscal front. So the way central bankers look at inflation is we basically try and strip out various components which we think we cannot control. Food and energy typically not a function for central banks. We look primarily at goods and services. And the idea here is really that core services, after stripping out headline, core services are really the most labor-sensitive parts of the economy. And this is what central bankers really care about, because to the degree that these labor-sensitive parts of the economy are charging higher prices, they're also able to pay higher wages. And this is the sort of dynamic that drives the wage price spiral that many central banks really start to care about. Now you'll notice that in recent times, the core services measure, core service ex-shelter, or the super core measure that the Fed favors, has actually started to tick up in the last couple of months. And this is even before all of the pass-through of tariffs into consumer prices in the US, suggesting that inflation in the US is still somewhat sticky, and perhaps some of this is being driven by the firmness of stock markets in the US in particular. Now, when we look at the labor markets, however, we can see that even though labor market is coming down, the labor market on the overall situation is still pretty firm. This is the Phillips curve on the left, and this is the way the Fed prefers to look at the link between the labor market and inflation. And as you can see, the lower unemployment is, the less slack there is in the economy, and therefore the higher risk of inflation being high. And this is an important nuance in the current debate about Fed policy, because the debate so far has been that labor demand is slowing quite materially, but because of Trump's immigration policies, labor supply is also coming off, and therefore the decline in labor demand that we're seeing isn't quite creating the same amount of slack that we would normally expect to make inflation a non-issue. This is somewhat concerning in the context of tariffs essentially starting to drive inflation expectations higher. You can see not only in the front end of the inflation expectations curve from the University of Michigan survey, not just the one-year expectation is going up, but the five-year expectation is also going up as well, suggesting that the risk of inflation expectations being unanchored by inflation is very, very real. So we are certainly staring at the risk of a significant de-anchoring and further spiral of inflation here, which makes next week's potential Fed cut quite interesting, being, you know, potentially one of the most politicized in recent history. Now, let me also talk about what's really driving the underlying inflation. And in the era that we have been through in the last couple of years, it's really not just about commodities, which are, again, typically inputs into goods. What's driving services inflation in particular is really the fiscal excesses. And again, this is the underlying driver of the move in gold that we've seen in recent years. So on the left, you'll see the cumulative change in the US fiscal balance since the year 2000. This was the last time that the US actually ran a fiscal surplus. And 2/3 of it is really coming from spending, entitlements, transfers. You'll notice I've colored this blue, and that's associated with the Democratic left in the US. And then about another 20% of this this is really tax cuts and Donald Trump's extension of the TCJA, which we saw a couple of months ago, is only going to add fuel to this fire. And the combination of these two tells you that no matter which government you get in the US, the fiscal picture continues to deteriorate. What has been on the margin a positive for the US, however, in the 2010s, is when inflation was low, interest expense was also very low, but that's no longer the case. So if you look at the top right chart, you'll see the two primary policy tools that the US policymakers have, fiscal and monetary. Generally, when the lines are going up, policy is tightening, and when it's going down, it's easing. And right now, you have a situation which is very unusual in that the left hand is fighting the right hand. The Fed is having to tighten policy, even though fiscal policy is very, very loose. And that fiscal policy is, again, a big driver of why the US economy is so exceptional in its strength. This is very unusual in the context of historical cycles, as you can see, coming out of recession cycles in the yellow bars. You typically get a rebuilding or retightening of policy on both fronts to essentially build space for the next potential shock. And the complicating factor here is that the US government's interest expense, which we think is going to be about 3.8% of GDP this year, is also the private sector's interest income. About 80% of that interest income flows through into the US private sector, which adds to the resilience. And this is on top of the Fed's tightening, having done actually very little to weigh on the private sector in recent years, because you can see that mortgage rates have risen very high, but because everybody's fixed out their mortgages for 30 years, household debt service ratios haven't actually risen quite as much. And in the corporate sector, because of the fiscal transfers from before, a lot of corporates actually paid down their debt and therefore haven't seen an increase in their interest expense that is commensurate with Fed tightening. So this is kind of the key thing that's driving the fiscal issue. And the key point that I would make here is really that the world's reserve currency issuer has a debt sustainability problem. And this is why you heard in the Mar-a-Lago Accord that was published last year, Stephen Moran, who is the White House's top economic advisor, now actually sitting on the board of governors, he basically proposed a way out from this debt sustainability issue. And it's some combination of default or devaluation or possibly both. And in the context of this, markets are kind of responding quite interestingly. So this is the front end of the bond curve on the left, and you can see supercore inflation has been keeping the market pricing of Fed cuts in recent times relatively elevated because inflation is sticky, the Fed has been unable to cut. And then further out on the curve on the right, you'll see that the 10-year US Treasury yield is no longer correlated with oil prices, i.e. markets are starting to tell you that inflation is no longer being driven by energy dynamics per se, but rather by the underlying fiscal issues that we just talked about. This then brings us to the dollar, and the starting point for the dollar, and this is the whole de-dollarization narrative that you may have been hearing a lot about. But the starting point is a very rich valuations. So the dollar is, by our measure, is about 7 to 10% overvalued relative to growth differentials. And if you look at the longer cycle, it's actually even higher, on order of about 15% versus long-term averages. The anatomy of a dollar cycle, however, you can see that in the green bars, when the dollar is going up, the current account tends to deteriorate. But what we also see is the net international investment position of the US starts to weaken as well. And this is essentially what drives the dollar cycle. It's really positioning in US assets. And the NIIP for the US has gone from 20% deficit, 20% of GDP deficit to about 80%, given the very long bull market that we've had for the dollar. So the world is overly long of US assets. And as a result, if we get some sort of a growth exceptionalism reversal, as we're expecting from Trump's tariffs, this can essentially drive a significant selling of US assets that will drive the dollar materially lower over the next several quarters. Now, Asia has a very interesting place in this whole story. When you look at the balance of payments for the dollar and for the US, you can generally think of it as the exchange of investments for exchange of goods. So you have, from a cumulative basis in this chart, you see that the net outflows on the left mostly go to China, Europe, and Mexico historically. But on the investment side, EMAX, Emerging Markets Asia ex-China, has actually been a very important source of financing into the US. You'll see the channels that has flowed through on the right, and you see mostly it's coming from bonds from that fixed income channel, this gray bars, and a lot of this is really FX reserve accumulation from Asian central banks. And this is very, very relevant in the context of, the kind of fiscal dynamics and the debt sustainability issues in the US, because Asians have a very strong preference for savings. Asian central banks, which manage the savings of nations, have historically saved in US dollars and US treasuries. But as the market is starting to find out, safe assets are no longer as safe as they used to be because of fiscal unsustainability. And as a result, we're starting to see savings flow out of US treasuries and instead into gold. So that's the kind of big picture for the macro picture that's driving the gold story. And again, this is all about the excess and those the excess making those safe assets less safe than they were before. Now, the discussion around gold and treasuries is an age-old one. These will have historically been thought of as fungibly the two safe assets for financial markets. One hedges you against inflation in gold, and the other gives you a rate of return beyond inflation in US treasuries. So the real rates implied by treasury inflation protection securities, or TIPS, in the US essentially have been a very good predictor of gold prices in the past. Those same real rates today tell you that the gold's fair value is about $700 an ounce, which I think nobody in this room wants to hear. But of late, I've actually started to reverse this relationship and run the regression the other way. Nothing's really changed about the yellow metal that we all love so much, but what has changed is the fiscal trajectory for the US being very unsustainable. And as a result, as people move away from US treasuries as safe assets, markets are essentially telling you that the implied real yield based on what gold has done should be at minus 5% today in the US. i.e., markets are charging a 700 basis point risk premium because US treasuries are no longer as safe as they used to be. And I find it very interesting that if you look at the total above ground stock of gold, the capitalization of that is now rapidly approaching that of the US treasury market. Markets are clearly telling you which assets they prefer as for tools as savings. And increasingly, we're seeing that gold is the savings vehicle of choice, particularly for central banks in the region. So this is our estimate of the dollar share of Asian central banks holding on the top left. As you can see, we're about 64% at this point in time. This share has declined by about 10 points in the last 5-10 years or so, but we're still above the global average, or the COFA average, which is 58%. Very interestingly, though, when you start to break this down into two clusters, the share of the economies where the dollar share has been rising and where it's been falling, there are only two economies in the region where the dollar share has been rising. One of them has a very special reason for doing so. The other has 5 economies in the region, including Thailand, by the way, and one of the economies in that falling cluster has lowered their dollar share all the way down to 30%, which tells you how much they are concerned about the fiscal unsustainability of the US. And this is also very interesting that the dollar share is falling at a time when the dollar is strong, i.e., people are starting to make non-economic decisions about how they want to save. A lot of this has been motivated by the sanctioning of Russia's reserves in 2022 after the invasion of Ukraine. And the kind of confiscation, if you will, is basically motivating a lot of Asian central banks in particular to find alternate vehicles of savings. Because if you're an Asian central bank, if you're an Asian economy, you are caught between the demand of the US and the supply of China. And as a result, you need to find a way to skillfully navigate both of those things. So Asian central banks, as you can see, have increased their gold share by about 2% since 2018. And you can see all the big culprits. Again, Thailand has been a big part of this given the cultural affinity for gold. But where do we go from here? The BIS actually recently published what it estimates to be the appropriate level of gold within a reserve manager's portfolio, and they think that it's somewhere on the order of about 10%. In fact, for emerging market economies, which are generally less stable balance of payments, particularly those that are tied to commodity prices, they actually think 20% may be more appropriate. Now, if you just take us from where we are today and getting to 10% for most of the Asian economies, how much that implies in terms of tonnage of gold. For China, that's 1,200 tons. For Japan, it's 400. For Korea and Taiwan, it's about 200 each. Thailand will add another 40. Singapore will add another 100. That brings us to a total of another 2,000 plus tons of additional gold demand over the next couple of years just to get to that 10% share for many of these Asian central banks. And this has really been the key structural shift driving gold over the last couple of years. Asian central banks and central banks on the whole have bought 1,000 tons of gold on average per year, and that is a near doubling of the pace before that, which was only on average about 450 tons per year. Now, on top of central bank demand, though, we are now starting to see the broader set of investors start to come back to the gold market. Gold has obviously been, as a commodity, a very good hedge for inflation over time, and generally commodities do that pretty well. But the challenge is that commodities have this unfortunate asymmetry in that they tend to be very levered to the business cycle. So if you get a recession, copper is going to do poorly, silver may do poorly as well. But historically, we find that gold actually is quite symmetric in its performance. Gold does well both in periods of high and rising inflation, but also in periods of low and falling inflation. So it hedges you against both inflation and deflation. And this is a major motivation for the broader range of investors starting to come back to the market. And this is coming in the form of ETFs recently, futures as well. But generally speaking, when you combine the broader set of investor demand together with central banks, this has really been the major driver for gold over time. So this is the model that we use to kind of do our gold forecasts. And you can see gold demand explains about 70% of gold price movements. And on average, when investor demand increases by about 100 tons per quarter, we find that gold prices increase by about 2%. So if you take the forecast that we have, which is 750 tons across all the investor groups per quarter, that basically translates into a 35 to 40% move for the year. That's roughly where we are today, but over the next 1 year, we think that this can continue and potentially even accelerate as the kind of, shall we say, issues around institutional credibility in the US continue to percolate. And that we think is going to take gold to about $4,000 by the middle of next year, and that's about 60,000 baht in local gold bar terms. I see some excitement about this number. Maybe I should have started with that. There is some downside to this story, however. When we look at the various segments of demand and their sensitivity to gold prices, you'll notice that actually jewelry demand typically tends to suffer as a result. And I think some of us in the room know this. Pattaya in particular, I've been hearing that gold shops are shutting down, goldsmiths are out of work, and gold and jewelry sales in Thailand are generally down, I think, at 1.50% year on year. And this is quite normal in the sense when you look at this bottom right chart, in terms of the contribution to gold demand growth, investor demand and jewelry demand tend to be negatively correlated. So they tend to move in opposite directions. When investors are buying a lot jewelry, retail get to buy less jewelry. And when investors buy less, gold prices come off. And then retail buy more gold as a result. And this is a general dynamic which is pretty consistent and certainly a big risk to the rally in gold. We find that jewelry demand in general tends to be the most negatively correlated with the overall price movements in gold. But when you combine the sensitivity of this sort of sensitivity analysis across all the segments of investor demand, we find that the net demand is still pretty positive. So we don't necessarily think that the softness in jewelry demand is a killer for the rally, as long as the momentum in ETF and futures continues to be strong, and that's certainly been the case in the last couple of years, in the last couple of weeks, sorry. That said, however, I think this speaks to a broader dynamic, and there's a popular saying in commodities markets, right? High prices kill high prices. So the cure for high prices are high prices. And this is quite evident when you look at valuations of gold over a very long stretch. So, for example, the ratio of gold to oil at this point in time, you need to go all the way back to the 1930s to get to this level of valuations in gold. The ratio of gold to wages, so using US average hourly earnings as a proxy, gold to wages, you need to get back to the end of the 1970s and the last big inflationary cycle to get to where we were. And valuations don't necessarily matter in the near term, but they do matter for the big cycle. So if you had bought gold in the 1970s, it would have been a great hedge. It did almost 16 times. But if you bought it at the end of the 70s, when the inflation cycle was starting to turn, you would have actually lost 50% of your money in the 6 months, in the 6 years after that. So valuations are certainly something that is a big concern, but we need some sort of a catalyst to drive mean reversion in terms of valuations, right? Either, wages or oil prices have to go up significantly, which is potentially a risk if the dollar declines a lot, or we can get a lot of supply coming through. And that's the other side of the picture for gold on the micro side of things. When you think about supply, people tend to think of mine supply when it comes to gold. In the last 5 years, capex has increased by has doubled basically, and that's quite material. But this still trails the 04-08 kind of cycle of capex that took 5 years and increased capex by about 5 times. More critically, what we find with capex is that capex tends to take about 4 to 5 years lag to actually increase mine supply, and therefore we're likely to face a period where supply and demand continues to be constrained. The other risk of supply is really scrap, and this is potentially people selling their necklaces because gold is very, very high. And again, this, the same way that valuations are giving miners very strong incentive to pull gold out of the ground, it's also giving retail very strong incentive to either sell their necklaces. You can essentially dissave that way because your one, gold necklace is now worth many, many weeks of income, and therefore scrap supply has also on the margin been starting to increase. And this is certainly a risk, but as you can see, scrap supply of about 1,400 in the last quarter or so, relatively small relative to mine supply, and we think that mine supply will ultimately be pretty constrained. So where does this leave us for the overall gold picture? The combination of elevated demand for an extended stretch of time because of the era of excess, if you will, we think that that's probably going to stay. These are not our precise forecasts per se, but just stylized kind of numbers to give you a sense. And then if you look at capex as a predictor for supply looking forward, that lags by about 5 years, which suggests to us that this demand-supply imbalance in gold is going to continue for quite some time because meaningful supply is still at least a few years away, and scarcity will continue to drive gold's value higher. So I hope that gets you guys excited about the gold story, but let me just drop one last point on the potential right tail for gold and gold prices in particular. You can see here on the left the total kind of share of gold in the liquid investable universe. So this is US equities or equities globally, fixed income, alternatives, and gold. And gold currently at about 5-6 trillion or so represents only about 2.6, less than 3% of that overall portfolio of 220 trillion that global investors hold across the board. This is a relatively small share. Now, in the last couple of cycles, when the dollar started to turn, what we saw is that foreign investors sold about 15% of their US assets. If we just take 0.5 points of those 15 points, and we reallocate those flows into gold, that essentially translates into about 160, 170 tons of incremental demand per quarter. And over the next 3 to 4 years, if we spread that out, that basically takes us to $6,000 per troy ounce, or for the locals, 90,000 baht per 15-gram gold bar. And this is essentially the long-run kind of target that we have for gold, even though it's not a precise forecast per se. This, I think, is something that is probably a long-term view, but a lot of the speed of the move here can accelerate and it can certainly overshoot, because in these calculations and these forecasts, we haven't even assumed any sort of non-linearity that might emerge because of a greater scramble for gold in a way. So I would say that these forecasts in some ways, somewhat conservative, if anything. And then finally, I'd like to talk about the Thai baht a little bit, because I know this is very topical with many of you in the room. And we look at the Thai baht, when we look at the balance of payments, one very key thing stands out, and it's the net errors and omissions. Net errors and omissions are basically a statistical discrepancy. The central bank will basically take exports, imports, portfolio flows, sum everything together, and they'll find that sometimes there's a gap between the number that they have and their actual change in FX reserves. Now, in Thailand, this is bloated to about 3% of GDP, partly because of gold, we suspect. When we look at NEOs in Thailand and we kind of run them a regression versus gold, we can see that the fit is actually pretty good. And this is very interesting because Thailand has positive NEOs while Vietnam has negative NEOs. I tell clients that Thailand is a safe haven of political stability, and clients kind of laugh at me because the last 3 times I've been here, we've had 3 different prime ministers. But relative to the Indo-China region, where Vietnam had a political crackdown that was very acute, arguably even more acute than China, relative to Myanmar, which has a military government, relative to the rest of the world, where there's a land war in Russia and in Ukraine, and Russians are coming to Phuket as a kind of a safe haven. The libertarian values of Thailand actually make the Thai baht a safe haven in many, many ways. But this is starting to become a meaningful issue for Thailand. The other way that gold affects the Thai baht is really what you guys here do, and Kun Pawan and Kun Golf. I promise you, I will tell the Bank of Thailand not to put in any additional rules. But when we look at the correlation between gold and the Thai baht, it is very, very high in the overnight hours. You can see in the London time zone and the New York time zone, the correlation is about 60%, whereas in the Bangkok hours, it's closer to about 40%. And when we break down the performance as well, and if you look at the bottom panel on the left, on the left chart, you'll see that actually in 2023, when the overall balance of payments for Thailand wasn't so great, actually the real economy flows in the Bangkok time zone, morning and afternoon, all pushed the Thai baht weaker. But in the overnight hours, when gold tended to rally because Trump would say something stupid or the Fed would do something and the dollar would weaken, you would essentially see gold rally in response, and Thai baht also tag along with that. And the reason here is really quite simple. I've been told that in the overnight spot market, the gold traders dominate about 90% of the flows. And in the absence of the likes of local importers who are buying dollars to offset or selling dollars selling from exporters, that naturally lets gold dictate the price action for the Thai baht overnight. So I do think that some degree of regulation or even deregulation might help here, but it's impossible to deny that gold trading has had some amount of effect on the Thai baht. That said, however, we think that obviously saving in gold is going to be something that is very, very important for Thailand and for Thais. And anything that the Bank of Thailand wants to do about breaking this link, it's important that they find a way to make sure that gold remains an accessible savings vehicle for the masses in Thailand. And this combination of the net errors and omissions and the correlation overnight, as an ex-colleague described to me, rich people trading gold late at night, and I think I see some of them in the room here. These have been basically the major reason why gold is so correlated with the Thai baht. And when we break down the performance attribution of the Thai baht since Trump won, pretty much about 90% of it can be explained at the bottom right. You can see in those gold bars, can be explained by the movements in gold itself. This is very, very ironic because everybody was very, very bearish on the Thai baht when Trump won. It's a trade-reliant economy that's been hollowed out by China, and there's significant kind of uncertainty around transshipment and things like that. But yet the Thai baht, despite its low-yielding status, has been the best-performing currency in Asia since Trump won, which runs completely counterintuitively to what everybody thinks about the situation in Thailand. And this is, again, despite all the political uncertainty that happened. In the last week, you changed Prime Minister here, but somehow the Thai baht actually appreciated 2%. And I don't know what to say, but again, the Thai baht is a safe haven for many FX traders as a result of these dynamics. Finally, one last thing, and I want to talk about, this is, I think, for me, really, really key. When you look about the valuations of the Thai baht, on the top left, you see the Thai baht real, so adjusting for inflation and versus a basket of the Asian peers. The Thai baht is about 9 to 10% overvalued at this point in time, by my metrics. This is a very simple way of doing things. When I speak to the Bank of Thailand, they don't necessarily agree, but I think this is ultimately the long-run anchor for currency valuations, productivity growth. And Thailand has suffered not having this, particularly against China. So when you look at that right chart, you'll see that the Thai baht is actually very, very weak versus the dollar. It's about 20% too weak versus the dollar since 2015, but it's about 14% too strong versus the RMB. So the weakness of the RMB also contributes to the strength of regional currencies, and Thailand in particular has really suffered from this. On the bottom right, you'll see kind of a proxy for the current account that Thailand runs versus both the US and China as two largest trading partners. And you'll see that the goods balance or the total balance in the early 2000s was about 6 to 8% of GDP, but that has declined to almost zero or negative at this point in time. Through the late 2010s, however, what we saw, those gold bars, a significant increase in tourist receipts. Thailand's reliance on Chinese tourism has essentially become a Dutch disease because it masked the underlying deterioration in the trade channel versus China and versus its external partners. The goods balance declined from 5% of GDP to basically about 1 to 2. And as a result, because young people were essentially going to service the tourism industry, they were not studying electrical engineering, and Thailand missed out on the kind of supply chain for electronics. It's also kind of missed out on the supply chain for EVs, although we're starting to try and break into that now. And essentially, the missing out of these productivity gains is a big reason why the Thai baht looks overvalued in my view. So an adjustment for the currency is certainly due. The point that I would make, and I've told this to the Bank of Thailand as well, is that strength has become a vulnerability for the economy. The strength of the Thai baht is not so helpful, even though it's it's a great way for people in the region to essentially preserve their wealth. So that brings me to the end of my talk, and let me just briefly summarize again. Safe assets are no longer safe in the era of excess, and a lot of this is being driven by the fiscal issues in the US and spills over into the rest of the world and the markets for safe assets like the dollar and US treasuries. Scarcity as a result is getting more valuable. This will drive gold to at least 60,000 Thai baht per bar in 2026, and perhaps over the next couple of years, take it all the way to 90,000. And then finally, Thailand should continue to save in gold, but inflation is actually somewhat useful in a world where we have many, many problems to fix, particularly in the era of Thailand's secular stagnation, where the Bank of Thailand has missed the inflation target for almost a decade now. That brings me to the end of my session. Thank you so much. Khop kun kap and Sawadee Kap.